everyone. Thank you so much for joining Americans for Financial Reform as we host our book talk fireside chat with Professor Lev Menand. Lev, thank you so much for being with us today and giving us a minute of your time. Well, a bit more of an hour of your time, but thank you.
Thank you so much for having me.
Yes, of course. I'm gonna tell you all a bit about Lev, and then we'll go into a brief Q&A between Lev and I, and then we'll take questions from the audience. There is a Q&A function where you could ask your questions. You can type it as we are talking, but we will ask it towards the end. Last 15 minutes or so, we'll read out the questions from the audience. Before I tell you about Lev, I'll tell you a little bit about myself. Renita Marcelin. I am the Advocacy and Legislative Director for Americans for Financial Reform. Previously, covering all things banking, systemic risk. So Lev's book, right up my alley. And now I'll tell you more about our honorary guest today. So Lev is associate professor of law at Columbia Law School. His research focuses on money and banking, central banking, and financial regulation. In 2018, he co-authored a proposal, Fed Accounts, Digital Dollars for the Federal Reserve, to offer the general public the option to hold digital currency accounts at the central bank. It has been endorsed by the New York Times editorial board, and legislation to implement his proposal has been introduced in Congress. He has previously served as the senior advisor to the Deputy Secretary of the Treasury from 2015 to 2016. While at Treasury, his portfolio included financial regulatory reform and financial inclusion, amongst other things. Lev was previously an economist at the Federal Reserve Bank of New York, where he helped to develop models for the Federal Reserve System's first comprehensive capital assessment and review, basically part of the stress test, and helped prepare the Council's first financial stability report. He clerked for judges on the U.S. District Court for the Southern District of New York and the U.S. Court of Appeals for the Second Circuit. So what a lovely and storied resume. Again, thanks for joining us, Lev. And with that, I think we should get right into it. So one of the first questions made it pretty broad, so Lev can kind of dive in and tell us a bit about his book, The Fed Unbound. And one of your central tenets of the book is that the expanded purview of the Fed, resulting from the global financial crisis, the pandemic, the prevalence of our shadow banking system, threatens our democracy and ultimately mostly benefits the wealthy. Can you give the audience a brief synopsis on how the Fed has expanded its role in our economy and why its expansion should be viewed with skepticism?
Yeah, thank you, Renita. Thank you to everybody at AFR for organizing this Zoom webinar. It's really great to be here. It's great to see so many familiar names in the participants list. And that's a great place to start. Let me just acknowledge right off the bat, the Fed has actually expanded its role in two ways, and neither of them are ideal from a policy perspective. The book really focuses on what's happened to the balance sheet and all the lending and purchasing that the Fed has done, which is a real change in the Fed prior to 2008, how the balance sheet worked. And argues that this is all about shadow banking and that most of the benefits flow to shadow banks and have led to a financialization of the economy and undermining of our banking laws. But let me come back briefly to the other way, which has to do with ordinary monetary policy and the way we now expect the Fed to fight inflation, which I want to argue is that dates to 1980, not 2008, but is another expansion in the Fed's role that I think is not good for ordinary people, not good policy overall. Doesn't mean that that every Fed action we'll be better off without it. It's just that a lot of what the Fed is doing is second best, third best, fourth best, fifth best in some cases. And so let me unpack it a little bit. So the Fed was set up for a banking system that that created the vast majority of the money supply. The Fed was established as a monetary authority. And so it wasn't built to do a banking business with the general public. It was built to superintend, to control the expansion and contraction of bank balance sheets. Banks issue the money that most people use for most things. Most businesses use for most things. That money is called deposits. They expand their balance sheets on both sides. This is really a public power that's been delegated into private hands for public purposes. And the Fed is there to make sure that the banks are doing this in a public-oriented way, and that the rate of expansion of bank balance sheets is conducive to economic growth and full employment over time. This is the whole Fed design. The whole Federal Reserve Act sort of presumes that that the banks are creating the money supply, and that the Fed is going to control bank balance sheet expansion and contraction. And the Fed has a bunch of ex-ante tools, regulatory and supervisory, for controlling what banks are doing. There's a whole bunch of terms and conditions. These range from what sorts of assets the Fed can create, what types of lending it can do, to things like the Community Reinvestment Act. There's all these requirements that go along with the franchise. And the Fed is there overseeing the operation of the system as a whole. And then there's ex post tools. If the system gets in trouble, the Fed can lend to the banks. There's a discount window. We have deposit insurance. It's a whole package. That's how the legal system is set up. That's how the Fed is designed. That's what it's designed for. It's a limited role. It has to do with steering this banking system in a public interest. And there's no sense in the Federal Reserve Act that there are going to be these other entities that are competing with banks and are not subject to all the terms and conditions of the bank franchise, and that all the Fed's tools don't work on them, especially the ex-ante tools. Fed can't supervise, can't regulate, and these are the shadow banks. And the Fed actually played a major role in creating the shadow banking system through its actions in the 20th century, offering ex post support to entities that were arbitraging the banking laws, that were trying to do a banking business without following any of the rules that go along with the banking business. And you have the dealer firms initially, and you have overseas firms, and the dealer firms are creating deposit alternatives called repos, and the overseas firms are creating deposit alternatives called Eurodollars. And these are economically equivalent in important respects, but they're completely regulatorily treated differently. This is the shadow banking system. Short-term financial commercial paper, another category. Money market mutual fund shares, a fourth category. Now we see stable coins. These are all created outside of the banking system and in a way inconsistent with the Federal Reserve Act. So the shadow banking system develops. Fed actually is playing, unfortunately, a role in its development. It gets way far away from, I think, what even the Fed officials who were involved in the 20th century expected. And then you have 2008, which is total unraveling of the shadow banking system. And the Fed finds out that not having all the tools to regulate this system is a huge problem. This system is hugely unstable. The dealer firms, which are really the first significant shadow banks to emerge, they are the ones that are the biggest, and they go up in smoke in the most dramatic way. You have the failure of Bear Stearns, the failure of Lehman Brothers. These are old-fashioned bank runs. These entities don't have bank deposits because that's illegal, but they've created functional bank deposits. And guess what happens? Their depositors, who are the cash providers in their repos, they just withdraw en masse, and the institutions collapse. And there's no discount window for them, and there's no deposit insurance for them. And so the Fed sort of stumbles along and figures out to create these ad hoc rescues to stabilize them. Why does it do that? Because the reality is, by 2007, 2008, that the majority of the money supply in the US is created by shadow banks. And so if you have shadow bank collapse en masse, you're going to have rapid credit constriction, you're going to have a depression. I mean, it's going to destroy the whole economy. And so there's no choice. The Fed, in some sense, is against the barrel, up against the wall, when the shadow banking system is completely unraveling. We could talk about whether Congress could have done things differently. Certainly, there was a range of ways of responding, but the idea that in this moment we do not want to allow the money supply to shrink rapidly, we have to somehow forestall failure. Do we have to protect shareholders? Probably not. But we need to forestall failure. Let's do this lending. The Fed is sort of forced into that And that's a fifth best thing to have happening. And now, since 2008, we're just living in the aftermath of this, where we continue to have this inherently fragile shadow banking system that requires more and more of the Fed's balance sheet support. So the Fed does QE1. It's trying to heal shadow bank balance sheets by creating new demand for mortgage-backed securities, which are assets that these entities hold. The Fed is providing huge liquidity to the financial system to make what's an inherently fragile system more stable. And then you see this again in 2019. You see it again in 2020 in a huge way. A big part of the Fed's response to the pandemic, the vast majority of what the Fed does during the pandemic with its balance sheet is about stabilizing the shadow banking system. It's a huge public subsidy that the shadow banking system is getting. Without any of the associated public requirements that are built into the banking laws. And so the shadow banks and the overseas foreign financial firms, they're not subject to CRA. They're not subject to any of the restrictions on the assets they originate, any of the rules. The ability of the Fed to prevent them from getting in trouble in advance is highly attenuated. They aren't supervised by the Fed as banks in many cases, or regulated. And this dynamic itself, by the way, has undermined all of bank regulation, because in order to protect banks against these competitors who are unregulated, we massively deregulated banks. So the dynamic effect of this is very deteriorating. So what we now have on this dimension is a Fed that has a huge role to play in stabilizing inherently unstable monetary system, and in doing that, make the problem worse down the road, even though in the short term avoids calamity. And I see most of what the Fed has done with its balance sheet 2008 as associated with solving this problem, and this problem has a lot of negative effects and really needs to be solved in a different way. It's not a good dynamic to continue to rely on the Fed to do this. We don't want a Great Depression, but we need a better system than massive Fed balance sheet expansion to support inherently unstable shadow banks that are not subject to bank regulation. Let me briefly say, I don't want to give such a long first answer. Let me just briefly say that the Fed has also been reinvented in the last 40 years as a sort of general purpose macroeconomic stabilization agency. So it's not just that it's playing this financial stability role, that really we should have structural reform to ensure stability rather than the Fed bailing out unstable firms. It's also that now we rely heavily on monetary policy to control the business cycle. And in particular, there's this idea that it's the Fed's job to trade off employment and inflation and to prevent short to medium term inflation. And that's nowhere to be found in the Federal Reserve Act. It's a misreading of Section 2A, which is added in 1977. The Fed's role is much narrower than that and much more about expansion, not about constraint. The Fed's job is to ensure that the money supply is growing adequately over the long term, consistent with long-term full capacity utilization. And so if there's inflation caused by various factors like a structural shift in the economy, supply chain, war, the Congress that wrote the Federal Reserve Act did not think that the Fed's job was to damp down the economy, induce a recession to cut off that inflation. And that's why Burns was clear about this, who was chair of the Fed in the 70s, that it wasn't his job to do that. Then Volcker does it anyway. There is a huge shift in American political economy and American governance, and the idea that we're just going to look at the Fed to do this sort of thing. And the reality is that we can manage inflation and disinflation and recession much better if we only rely on the Fed and money, control of money, as one piece of this. Credit controls, fiscal policy, automatic stabilizers, in some circumstances, targeted price and wage controls, all sorts of other tools can potentially be used in a much more equitable way to control macroeconomic stability. And going to the Fed as the only agency with any discretion in this regard, this is something that's happened. This is a way in which the Fed has sort of become unbound also. And I think it is it's unappealing. And so do we not want to have a central bank? No, we definitely want to have a central bank. We want to have a central bank that is doing things it can do effectively and do them in ways that serve the public interest. And other missions that can be done more effectively by other actors, we need to move and we need to develop our governmental capacity to solve problems more effectively going forward. And that's the argument of the book.
Thank you for that, Lev. And it actually goes right into my next question. Just now you outlaid pretty much that the root of the Fed being unbound is the shadow banking system. And in your book, you outlined that really well, as you just said, going back to 1957, when the Fed chairman then allowed the repo market to flourish, the backstopping euro dollars and such, the money market mutual funds. Given that, as you said, that is the ultimate cause, because now we expect the Fed to act as a lender of last resort for these type of products as well, and the institutions who provide them. But also the fact that Congress has also shown little appetite for many of the fixes, you suggest in your book, and you just suggested as well in your first answer, such as, again, maybe closing the deposit loophole, the Fed accounts proposal, public banking. Under these circumstances, when you take those two things together, would it be fair or prudent to say, what would you say to those in this circumstances, it's prudent to re-examine the role of the Fed?
So I think that we need to be practical about what we are pushing for in different areas of policy. And so, for example, you see in 2020, the Fed establish a Main Street lending facility and a municipal liquidity facility, which it is more or less directed to do by Congress in the CARES Act. I think that the Fed's interest and willingness to engage in this and Congress's willingness to do this has to do with the huge amount of lending that the Fed is doing to the shadow banking system. And so there's a sense in which these programs are cover for large support to the shadow banking system that we need to not lose sight of. But of course, if the Fed is doing these programs, we should push the Fed to do them right. I think what the reality is the Fed is unlikely to do them at the sort of large scale that we would like to see. It's not institutionally designed to do that, and it's and you see this in the results. So there was maybe a total of $40 billion of lending. There was hundreds of billions of dollars of capacity authorized by Congress, $40 billion of lending to non-financial actors. And all the while during this period, there's $3 trillion committed to support the shadow banking system, the financial system, private equity, hedge funds are bailed out really in subtle ways. It's not like the Bear Stearns deal where there was a deal and it drew all this attention. The Fed did it by massively expanding its balance sheet by adding financial assets, which functioned to save lots of financial firms that were in serious distress. And so you have a $3 trillion plus backstop at this period, support by the Fed for the financial system, and $40 trillion ultimately it goes to benefit non-financial actors. I think this shows us that we should not be looking to this institution to do this sort of thing. And I actually think the administration, in some sense, has learned this lesson. The Inflation Reduction Act. They are creating large government programs with hundreds of billions of dollars of government spending. They're not looking to the Fed to distribute that money. They're looking to actors who are more likely to distribute it in ways that serve the public interest and that are less likely to steer the benefits to the financial sector or to move through the financial system. And Fed programs tend to be financialized and move benefits through the financial system. And I think that we should try to design public policy that is less dependent on financial intermediation. And the Inflation Reduction Act is a good example of that. So I don't think it's right to conclude that Congress is incapable of coming up with a better mousetrap. I think that increasingly we're aware that there are better ways to do this, and we need to push on more of that and not not look to an institution like the Fed that's designed in a very different way to do something very different to broaden out and suddenly offer support to non-financial actors.
Thank you for that. And I'm glad you brought up legislation, because we can go back to the CARES Act. And there, from a lot of the programs that the CARES Act authorized the Fed to do, your book also describes how the Fed, in a way, was acting as a national investment authority. We can see from their programs that allowed the Fed to buy corporate bonds on both the secondary and primary markets, the purchasing of municipal debt. I think at one point, going back to corporate bonds, there was even the high yield, the junk debt program, even lending directly to small businesses and nonprofits. What would you say to folks who argue that this is needed, given that the Fed's previous actions of supplying relief to Wall Street in hopes that it will trickle down to Main Street has many times failed?
Yeah, so this goes to exactly, I think, what I was just trying to say about how the Fed was acting as a national investment authority, but it's not built to be a very good one. And so if that's going to be our national investment authority, we can expect industrial policy out of the Fed to be very pro-financial sector. A lot of the types of facilities that the Fed created really benefited the financial system, healed the financial system, led to record financial sector profits. And there were other benefits to other areas, but it's going to be a finance first sort of policy approach if that's our NIA. What would be better is to set up a different NIA that's structured differently, that's not the Fed, to do those things, and we would get much better results. And that's what I was sort of suggesting with the Inflation Reduction Act. We're likely to see much better climate and energy policy come out of grant programs from the EPA or the Department of Energy than a Federal Reserve facility for green energy lending, for example. And so that's sort of the argument of the book. It's about taking seriously the different institutional competences and the Fed's record and what it's capable of and what it's best suited to do.
My question to you, and then we'll take questions from the audiences. But again, you mentioned quite a few times how the distributional effects of the Fed policies will definitely be inequitable, and most cases benefit the wealthier individuals, the people with higher incomes, and again the financial sector. But in your book, for example, I think you lay out the example of the asseters and the debtmans. I'm probably mixing up
those names up. Yes, people who have assets and people who have debt.
Yeah, exactly. And you did show how, again, they both benefited, but the asseters benefited more. And I guess the question to you is, some critics would respond that the Fed actions ultimately did lift all boats, even though some were lifted more than others. So if you can just walk us through a little bit of, we could probably use some of the CARES Act programs, which you lay out so lovely in your book, but walk us through a bit on how those policy decisions have contributed to increasing economic inequality. And again, what do you say when folks are, and we hear that many times that it worked. So
this is a really important question. Yeah. So I'm glad that you asked this. Narrowly, when we're talking about should the Fed pursue easier monetary policy, should the Fed expand its balance sheet, should the Fed buy more QE, and we're holding everything else constant, when the economy is in a downturn, when there's a shortfall in aggregate demand, the Fed taking stimulative action is better, all else equal, than the Fed not. And so it would not be good for the Fed to raise interest rates when you have a pandemic on the horizon. And so it's certainly true narrowly that Fed easing and balance sheet expansion lifts all boats to some extent. But as you suggested, it doesn't lift all boats equally. And so my critique has to do with our reliance, our dominant reliance on the Fed in these situations, and what sort of macroeconomic stabilization agent is the Fed. It's true, macroeconomic stability benefits everybody. Everybody is better off when we avoid a recession or a depression. We really don't want to be in a recession or a depression. And so when the Fed takes actions to avoid a recession or depression, people at the top and the bottom of the income distribution are benefiting, significantly benefiting, because the Fed is preventing a run-up in employment. That losing your job is a horrible thing to have happen. And so when the Fed is providing macroeconomic stabilization, everybody is getting the benefit. Question is, are there ways to provide macroeconomic stabilization that are more equitable? Who benefits from having the Fed be the macroeconomic stabilization agent and everybody rely on their tools for stabilizing the macroeconomy? And the answer is, I think, the financial sector and asset owners. They benefit a lot from this way of doing macroeconomic stability because the immediate benefits flow through them. So there's like a trickle-down effect, but a lot of the immediate benefits, the money that goes, where does the money go immediately to stimulate? It tends to be wealth effects for rich people, stronger bank positions. And so you have a type of policy that's flowing through the financial sector. And so whenever the government wants to stimulate, the financial sector is going to feel it first in a good way. And so this is a macroeconomic stabilization policy that's finance forward, and that's often asset owner forward. And it does benefit everybody, but compare it to a macroeconomic stabilization policy that is checks to people making less than $100,000 a year, say, or anybody at the poverty line or below, or up to 2 times the poverty line. If we're going to do the same type of stabilization, but that instead we're just going to increase the bank account balances, we're going to introduce $1 trillion of new money, but instead of doing it through traditional monetary policy, we're going to just write checks. You can get a lot of good macroeconomic stabilization from that. You can get the same amount of macroeconomic stabilization as a change in interest rates or a purchase of quantitative easing. But now, who's benefiting first? It's the money's going directly to people who are going to spend it and who need it the most. And so relying heavily on the Fed means not coming up with all sorts of other tools for stabilizing the macroeconomy that would be much, much more equitable and actually, in many cases, much more effective than monetary policy, which we need someone keeping track of the money supply. But do we want to use changes in the money supply and changes in financial conditions as our primary tool for managing economic conditions? And I think the answer is no, because that's going to be a system in which we have a very large financial sector, larger than we need, and a sector that requires a lot of public backstopping, more than we should have the public provide.
Thanks for that, Lev. And yes, very insightful. I think, yeah, you alluded to the automatic transfer payments in your book, as well as one of the policy solutions. Again, that goes to how do you get benefits directly to the people in a more equitable way? I'm gonna start taking questions from the audience now. We have a couple so far. If you have questions, I encourage you to put it in the Q&A function. There's a button there that you all should see. But yes, our first question from the audience, given that institutions such as BNY, Mellon, and Fidelity are starting to offer Bitcoin to their client base, how do you see Bitcoin existing alongside CBDCs, central bank digital currencies? And maybe I'll expand that a bit further to not just, talk about Bitcoin, but probably, stable coins that are a deposit equivalent, but from the private sector.
So great question. I think that important to distinguish between Bitcoin and Ether and dollar-denominated cryptocurrencies because they have different potential uses and different ways of intersecting with the existing regulatory framework. So Bitcoin, the theory of Bitcoin changes, year to year. Initially, it was going to be a sort of reaction to the financial crisis. We'll create a fully private monetary system, and then with a different new unit of account. We won't be on the dollar. We'll be on Bitcoin. It'll be subject to clear fixed rules, and it will be better. I think that project was always misguided, misunderstood how money works, and the history so far bears out that Bitcoin has gotten very, very little traction as a functional money, as a functional substitute for any of the existing monies that are used around the world. Bitcoin would be a way less efficient, equitable means of payment, store of value than even the dollar system we have right now. And so Bitcoin has evolved into a sort of speculative asset. Sometimes people call it digital gold, some non-government store of value that a group of people can agree on to use, and is easier to move around than gold. And I think this is what has undergirded the interest of institutional investors, Fidelity, BNY Mellon. There's some idea that this is some new asset that might be an inflation hedge or some other type of hedge, like gold. I think that the case for that is also fairly weak for a variety of reasons that we could get into. But I think that it's not likely that we're going to see Bitcoin used for other purposes than that. And so then the question becomes, to what extent should traditional financial institutions subject to public regulatory regimes make space for this new asset, or things like it? And I think that we can get more into that. It's a complicated set of questions, but as an initial matter, we don't want to have traditional financial institutions investing for their own account in Bitcoin or something like that, because this is a highly speculative asset that might have zero underlying value, and might go to zero at any point in the future. It doesn't have any fundamental value. But can trust companies facilitate holding of this by informed investors? In the case of Bitcoin, perhaps there's a way to do that. I don't think that's a major issue that policymakers should be focused on. There are so many more important things that policymakers need to focus on. Then there's a whole bunch of other cryptocurrencies that aren't quite like Bitcoin that actually resemble securities. Well, those need to be regulated under the securities laws. And those are a whole bunch of other different, those raise a bunch of different questions from Bitcoin. Stable coins are a new shadow bank product. And so that's, there are issuers there who are issuing the stable coins, and they're basically illegal banks, or if they're legal banks, they're through a loophole that's in the banking laws right now. And we need to modify that legal regime because we do not want to introduce more types of shadow banks into the system. And ideally, we could use the opportunity of stable coins to address loopholes and come up with a more coherent bank regulatory regime that applies functionally across all the different types of banking activity.
Thank you, Lev. And another question, again from the audience: what do we do to wake up macroeconomists to the dangers of the Fed's past and emphasis on past actions? They follow monetary policy closely, but fail to see that you need sensible financial regulation if you have an easy money environment.
That's a great question. I don't have a great answer. There's been a problem in the academy of over-specialization and abstract theorization, in particular in economics, that has led to a big knowledge gap between where academics are and economists, how economists think about the world and how the world actually works. And there is a really important role that financial sector and the monetary sector plays in the macroeconomy, and we need an integrated approach to those areas. And it's incoherent to approach them in a separated way. And I think repeatedly finding that out in practice is hopefully changing how people are thinking about this, and repeating that these things are connected, hopefully will change. I don't have a silver bullet there, but it's obviously the case that financial regulation and credit creation and how it's created, where it's created, is a huge part of macroeconomic stabilization. And we need to rediscover those set of tools and those sets of concerns to avoid bubbles and boom and bust cycles.
Thank you. The next one I want to ask, we have some more flowing in. Chairman Powell announced last week a review of the CARES Act facilities. What do you expect to result from this review, and may there be opportunities for public input in the process?
I don't know what will result. I think this is an interesting exercise, and that we'll learn. We may learn something about the Fed's internal views about these programs, and the likelihood that they would pursue similar programs, be open to pursuing similar programs in the future, and on what terms. And so it could give us some sense about what to expect from the Fed. So, all else equal, I'm glad that they're doing the review, because it will give the public an opportunity to assess their own how the Fed approaches its role in 2023.
And the next question, I'm just a statement and a question, I'll just read it. Public Citizen agrees with your analysis on the Fed and recommendations. We support a national infrastructure bank. That said, we have a Fed and a Congress unlikely to change reality much in the near future. We have an existential threat, climate change. You argue that the Fed shouldn't meddle with this issue, but it should have steered CARES Act money, but should it have steered CARES Act money to the oil sector, including failed OFR, I'm not sure what that acronym means, failing firms, as a Public Citizen report described? Shouldn't the Fed help address climate change instead of claiming it is limited to inflation and full employment?
So this is a great question. I'm not sure where I've argued that the Fed shouldn't meddle with climate change exactly. I would say, just as an initial matter on the climate change issue, there are clear ways in which climate change intersects with the Fed's mandate and tools, namely bank regulation and supervision. And so it's the Fed's job, it's required under existing law, to ensure safety and soundness, and that includes monitoring for a number of risks to bank solvency over the long term. It's entirely appropriate and, in fact, required that the Fed monitor the banking system to ensure that it's not exposed to various climate risks. That is separate from whether the Fed should turn its tools in some way to have an affirmative greening policy, or an anti-gray policy. And I think that's certainly something that Congress could mandate that the Fed do. But there's lots of reasons to think that the Fed is unlikely to, given the way that it's designed, pursue an optimal first best or even second or third best greening policy. And I think you point some of the problems insofar as the Fed has intersected with this already. It's actually, it appears that some of its lending has actually been going in the other direction to support fossil fuels. I think that should suggest to policymakers who are interested in addressing climate change that we need to build up other institutions with different capacities for for addressing this problem. And it doesn't mean that we shouldn't put pressure on the Fed for in whatever programs it is operating to do them in a public interested way. If it's engaging in general lending programs, it certainly should be taking these things into account. General lending programs aren't built into the statutory scheme. I don't expect the Fed to engage in further general lending programs unless there's another statute like the CARES Act. And if there is, we should be pushing to ensure that climate is built into that. Or else we should do what the IRA does, which is develop climate capacity in institutions that are focused and expert on climate. And so, maybe that's not satisfying, but that's sort of my reaction to what we've seen so far, and my understanding of how the Fed is set up, and what I think we're likely to see in the future.
Thank you, Lev. I hope I did justice to that question. Unless I'm still taking questions in the chat. Please feel free to send more. If not, I thought we have one more coming in, but yes. So again, if there are no other questions, Lev, this has been lovely, and I highly recommend your book. It was great holiday reading. My 2 weeks on vacation. And again, the Fed Unbound, Central Banking in the Time of Crisis. And if there are no other questions, I will give everyone back their 15 minutes.
Thank you so much, Renita.
Thank you, Lev. This has really been great. Thank you so much, and very informative as well. Thank you, everyone, and enjoy the rest of your evening.